we'll start the foreign tax credit limitation. Now, obviously, the starting point is always, why is it there? Why do we have a foreign tax credit limitation? And the short and simple answer is that the U.S. and virtually every other country that has a foreign tax credit mechanism, they want to protect their domestic tax base. They want to protect their domestic tax base. So if I have a, just as a, again as a simple example, if I have a U.S. corporation and it has a branch in a high tax place, let's say Germany. I'm not sure whether Germany today is so high tax. Let's make it Japan, which is still higher tax, although there has been rumblings within the Japanese tax community about the government reducing rates there quite a bit. But at least presently in Japan, if a U.S. company has a branch there and earns income, it'll be taxed, give or take a little bit, at around 41%. And of course, we have a 35% rate in the United States. Now, let's assume that this U.S. company has 100 of domestic income and 100 of income from the branch, which we'll say is foreign income, and as a result has 200, and that times 35%, of course, gives 70. So before foreign tax credit, there's a 70. There's an amount of 70 of total tax. Now, I said the U.S. wants to protect its tax base. Okay, the 100 of domestic income, if you just sort of look at it separately, you'd say, well, 100 times 35, the U.S. tax base should have 35 of tax on it. So that's what the U.S. is trying to protect. So we need a mechanism. We need a mechanism, and that's what 904 is. A mechanism that protects the tax on this 100 of domestic income, which also happens to be 35. So that leads us back, I think, to the formula, which hopefully is on the chart here, which is foreign source taxable income over worldwide taxable income times the U.S. tax before the credit. And where do you find this? You find this right in the language of 904A. So they're in a living color. Now, if you rework this formula a little bit, foreign source taxable income, instead of having, the foreign source taxable income over the worldwide income, if we change it and we say the U.S. tax before foreign tax credit over worldwide taxable income, that's really the average effective U.S. tax rate. And in this world, this simplistic world where we're assuming that everything is 35%, it works out nicely, of course, when we throw in some numbers, going back to our chart here, or going back to our drawing. We, of course, will see that if we take the U.S. tax before foreign tax credit, which is the 70 U.S. tax, times the foreign source taxable income, which is the also 100, over the worldwide taxable income, which is 200. We see that this gives us 35, okay, a foreign tax credit limitation, which, because the tax of 41 is higher, we get a full foreign tax credit of 35, not 41. And we end up, of course, paying 35 to the U.S. government. I apologize for using 100 and 100 as opposed to, for example, 100 and 200. Let's rework the numbers quickly to do that so that it becomes a little clearer. Let's say we have 200 domestic, which gives us 70 up here, which gives us 300 here, which gives us 105 here, and which then gives us 70 over here. So then we have here the 105 times 100 over 300, and the limitation is not 35, it's now, I'm sorry, it's still 35. Hopefully that makes it a bit better. Pardon?
Is limitation 7?
Well, what's 1/3 of 105? 100 over 300 times 105.
Okay.
Professor, I think you want 200 there, foreign source taxable income 200.
No, I said the
Oh,
200
I'm sorry, you're
was
right.
domestic.
Sorry.
Yeah. Thanks, Phil. Okay, so the point is that through this mechanism, although the total tax that Japan imposed is 41, we can only take 35 of it. And that means that we have paid a full 70 on the domestic income of 200. We have protected the U.S. tax base. You look puzzled. That's Rika?
Yeah, I'm just not completely sure I get it. So we end up paying 41 to Japan and another 35 to the U.S. Or
Well,
70.
Well, we on the branch income, we're paying 41 to Japan and 0 to the U.S. If we break, let's show it in a different way, because that maybe we can make it a bit clearer. Okay, let's make two columns, domestic and foreign. Okay, and we're saying that the income, net income, and let's put a total column as well. The domestic is 200, the foreign is 100, and the total is 300. Let's first do the U.S. tax computation, because we already know that 41 is how much foreign tax there was on the 100 of branch income. Okay, so tax at 35% is going to be 70 on the domestic income, 35 on the foreign income, giving a total of 105. Now this is before foreign tax credit. Okay, now we want to, of course, throw in the foreign tax credit computation. And we say, okay, we have this limitation formula. We know that we're going to have to multiply 105 times foreign source taxable income over worldwide. Foreign source is 100. Worldwide was 300. So our foreign tax credit limitation is equal to 35. We're able to claim as a credit the lower of actual foreign tax paid or the limitation. The lower of the two is the limitation because the foreign tax at 41 is higher. So we now draw our line, and we now have 70 of domestic tax, 0 of foreign tax, and of course 70 over here. Does that make it a bit clearer, Rika?
Thank you.
So again, the point is this limitation is focused on protecting the tax base in the United States on domestic income. Now, because the actual tax that was paid to Japan was 41, and we've used 35 of it, there's 6 left over. And this is an excess foreign tax credit. That's what we're talking about when we use the term excess foreign tax credit. We also see a term which is excess foreign tax credit limitation. That's what happens where the limitation, let's say the limitation of this 35, but maybe we're operating in Hong Kong, which has a much lower tax rate. Let's say it's 16 of actual foreign taxes. In this situation, we have more limitation than actual taxes, and that gives us a 19 of excess foreign tax credit limitation. This is a nice situation to be in. Why? Yeah, if you happen to have foreign taxes on other income, for example, remember we said you only have to recognize a dividend, you only have to recognize in your income, if you're a parent company, the earnings and profits in your subsidiary if you pay a dividend. Well, gee, if I have excess limitation and I have some high-taxed earnings overseas, I can arrange a distribution, have one of those, where I bring up a lot more taxes as deemed paid credit than I'm really bringing up, in a sense, taxable income. And I generate, in a sense, an ability to reduce my tax simply by paying a dividend. Let me see if I can make that a little clearer. Okay, we have a situation where, let's say, the U.S. company has a foreign subsidiary, and let's say this is in a high-tax country. So let's say it's, again, Japan. Let's say that it has that 41% tax rate, and that leaves 59. Okay, remember, we don't have to pay a dividend, so the earnings stay down there. But if the U.S. company happens to have this situation of an excess limitation, then when it actually makes a distribution of 59, and that becomes a dividend income of 59, a deemed paid credit of 41, 100 of additional earnings. And now we're just focusing on this aspect. The U.S. company also has, other income and expenses, and as a result of all those other income and expenses, it has this, let's say, 19 of excess limitation we mentioned. Because this 41, in other words, the additional 100 of income generates 35 of additional tax, but we use 41 of, we have 41 of deemed paid credit, so that generates 6 of excess foreign tax credit. We now can use that to just reduce our tax on this other low taxed foreign source income. Again, from the standpoint of trying to make a chart which hopefully makes a little more sense, let's say that net income. Okay, so let's say this is the all other column, and this one is the dividend from Japan. And, well, actually, I mentioned Hong Kong before, so let's say that this U.S. company only has activities in Hong Kong and in Japan. It has a branch in each place. So let's say it has 100 of income from each place. And then we have total over here. No other items of income and deduction, just branch income from each of those two. We then say of course, the U.S. tax before credit at 35% is 35, 35, 7. We then say, okay, how much foreign tax credit? The foreign tax credit is calculated on an overall basis. So when we do that formula, we say, okay, 200 of foreign source income over 200 of worldwide taxable income. Foreign source TI times the tax before credit of 70, and that gives us 70. Okay. So on an overall basis, our limitation is 70. Now, how much tax did we pay? We actually paid to Hong Kong, let's say 16. We paid to Japan 41. Those two together come to, 57. So now, when we do our foreign tax credit up here, we take the lower of the actual tax paid, or the limitation, and we have 57, which results in 13 of additional tax. Now, let's ignore that for a moment and pretend we just had the one and we had the other. Hong Kong, if we only had Hong Kong, we'd get a 16 credit. If we only had Japan, we'd have a 35 credit, because it's limited under that foreign tax credit limitation formula. So if we're looking only at Japan, we'd be limited to 35. Now, that would result in tax on the Hong Kong income of, what is that, 19, and 0 over here, and together that comes to 19. But because we do this computation on an overall basis, we have only 13 of tax. We were able to use the additional tax that we paid to Japan against the lower taxed U.S. or against the U.S. tax on that lower foreign taxed Hong Kong income. We're using the 6 of excess credit. Remember, 41 minus 35 is 6. We're using that 6 against the tax on the Hong Kong income. So 6 minus 6 from 19 gives us 13. Is this making sense? Not making sense? This ability to cross credit between a high tax, tax from a high tax country against tax on income from a low tax country, this ability to cross credit is a major point of the foreign tax credit and the planning which is done to maximize its benefit. And it's at the heart of what we're going to get into when we talk about the separate baskets, which will be next time. Yes?
Where'd you get the 6? Just so.
Oh, I'm sorry. The 6 is the 41 of actual tax paid to Japan minus how much credit we were able to take.
Okay.
So that gave us the excess foreign tax credit. Now, an interesting part of this is that if we have, a company which is directly conducting business in other countries, of course, income will be generated whenever you happen to earn income. These are direct taxes on your operations. But if that 41 of tax is paid within a subsidiary, now you're in control regarding when you make that distribution and trigger that tax credit. You're in control as to when you pay a dividend. And as we'll again talk about in future weeks, you don't even have to pay a dividend. You can take certain actions which will allow you to say that you have a dividend even though you didn't make one. That's your investment in U.S. property under the Subpart F rules. But the point is, there's cross-crediting, and when you do it through foreign subsidiaries, you can choose when to bring up either high tax or low tax income in order to maximize your ability to cross-credit. Last comment before you escape for the evening. And that is, I referred to this as an overall foreign tax credit computation. Okay, why did I say overall? What's that in contrast to? Well, we used to have, and a number of other countries still have, country-by-country limitations. Instead of having one overall limitation where the taxes and the income can be any country whatsoever, we used to have, and a number of countries still have, a country-by-country limitation such that you could not cross credit between countries. You could only use that extra 6 down here. You could only use that extra 6 against against U.S. tax on income from Japan. You could not cross credit against low taxed income from Hong Kong. So that was called the per country limitation. And it's not inconceivable that that might come back to us someday. The country has flip-flopped a bit over the years. So just, don't worry about the details of it, but just understand that it's out there. And you'll still see references in some of the regulation sections to the per country limitation. That's what it's talking about. Okay, any other questions before, as I say, you escape for the evening? Okay, well, thank you very much. See you next week. Now, when we finished last time, we had been going through the, let's say, initial discussion of the foreign tax credit limitation. So we're going to continue on with that. We will, with some reasonable amount of luck, finish the foreign tax credit tonight and then start the next section, which is the subpart F and section 1248 discussion. And I believe you should have all received an email from me indicating that the slides for this new section are on the website and available for you there. Now, we talked, of course, about the formula quite a bit last week. Remember the foreign source taxable income over worldwide taxable income times the U.S. tax before the credit, and that gave you the limitation. So, that was our basic formula. We talked about what it means and why it's there, that it's there to protect the U.S. tax base. So, if we spend just a moment or two to talk about, well, gee, what are those numbers? What is foreign source taxable income? What's the statutory basis for it? What generally is it meant to be? The next, at least 2 or 3 slides, which I'd like you to look at in detail on your own. We won't spend much time talking about them in class. But the basic point, if you think about that formula, foreign source taxable income over worldwide taxable income, where do the numbers come from? The worldwide taxable income is going to be that taxable income that the company or the affiliated group filing a consolidated return has as its worldwide income. That's basically it. No special computations to get to it. In a sense, the company has to do it anyway to calculate U.S. tax, or the individual, if it's an individual, has to do this to calculate his own tax, income, deductions, so on. For the foreign source taxable income, this is why you studied the source rules in the last course. You had, I don't remember whether it was 1 or 2 units in the book last session about source of income. And we talked during our look-back period a little bit about the concept of source and how there can be problems and issues in figuring out what the source is. But you can see the relationship between the foreign tax credit and the source rules, because that foreign source taxable income number is just so absolutely important to that formula. So you need to look to those source rules to figure out, gee, what is my gross income from foreign sources? And this is a transaction by transaction analysis. You can't just look at the whole company and say, well, gee, this, all of it should be treated this way or that. It's really a transaction by transaction analysis. Now, we've talked a few times about there being gross income and deductions to get down to taxable income. And when we look at how much taxable income there is with respect to foreign source income, we have rules which tell us how to allocate expenses. And again, that's your 861-8 through, I think through 14 or 15 or 16, somewhere in there. Those regs which give you rules on how to calculate that. So again, hopefully you saw some of this detail within your course last semester, but this is why it's important. Now, if you look at 904B in the code, you see about a page of fine print, which is reasonably miserable to read. The question is, why is it there? If you think about the formula for a moment, foreign source taxable income over worldwide taxable income times U.S. tax. Are all types of income taxed at the same rate for an individual? I heard a no. Okay, so explain a little more.
Ordinary income versus capital gain rates.
Yeah, ordinary income and capital gain rates. Absolutely right. Well, isn't this a little bit of apples and oranges then, if we're looking at foreign source taxable income over worldwide taxable income times U.S. tax? Because maybe the U.S. tax has some portion of it which was 15% rate income, and some portion of it was, well, whatever your bracket is, or just to use the simplistic 35% on ordinary income. So we have an apples and oranges situation. So what 904B does is says, hey, we have to adjust for this. We have to use some sort of, in a sense, weighted calculation to adjust how much taxable income there is in order to get a real valid and theoretically correct limitation. So without going into detail, which is frankly reasonably miserable, if you have the situation, which I have to say that my wife and I, as it turned out, fortunately had in our personal tax return, your best bet is to try to follow the instructions in the form, when you calculate these things. But this is what the section is meant to do, and it can have a material effect because it's trying to get to a theoretically correct answer, given that not all income is taxed at the same rate.